Going back to the hedge fund side, absolute return, we talked a bit about the CTA space, macro. How do you feel about macro? Because macro is it's always pre-COVID, it's been underappreciated. And then it really hit the limelight through COVID and post because fundamental managers got wrecked. Multi-managers did very, very well, but that was a diversifier effect. But macro has consistently been one of the top performing strategies. Like, how are you placing macro in your book moving forward, especially given the world that we're in now? Right?
Yeah, it's a really good question. It's a timely question because it's evolving and it's a dynamic situation. And what I mean by that is if we go back in time, macro had some differentiated periods of returns, but it really performed very well in the year 2022. That's when the Fed was hiking, risk assets were selling off very precipitously, and there was a relatively long runway to capture the opportunity set there in currencies, in the bond markets, et cetera. And that was an excellent year for discretionary macro and the systemic macro managers, CTAs, for example. But ever since then, it's been more difficult. Ever since the beginning of 2023, it's been a more challenging environment. As we talked about earlier, there's more control in this period in terms of the key actors impacting the markets in a shorter time frame, which is more of a challenge for some of these managers. And if we review some of the major dislocations, SVB in March 2023, the dollar-yen unwind in July, August of last year, the tariff volatility this year, the macro managers and certainly systematic macro managers also lost during those periods. So what you hope for is diversification. You hope for sometimes, maybe not all the time, that they will perform during these reversals or dislocated periods, but they have not. So that brings the question to allocators now, what's their outlook? Will that continue to be the same or will it be different? And if yes, how can we have them in the portfolio?
Yeah. I guess you really need to have that relationship. You can't just blindly pick macro managers there because they're so differing in their styles as well. You have global macro, Asia macro, you have macro expressing in equities. I'm seeing a lot of that more frequently now. And you have this sort of, I wouldn't call it style drift, but cross-asset bleeding where you have managers who are using other instruments or multi-assets to express their view. And this makes it a little bit tough sometimes for the allocators because you might have another manager that covers that asset class already. But there's a bit of overlap. What about SMAs? Are you guys doing any SMAs, or structurally, are you only sort of allocating externally, or do you have SMA internal managers as well?
We tend not to. We tend to invest directly in the funds because we have two parts of our business. One is a seeding part of our business, and then one is investing as LPs into their business. So as a seeder, we want to support the growth of the main fund, so we'll tend to invest in that fund. And then on the investment side, we will tend to invest with the fund. I think there's so many high quality managers that are available to invest in, that have been seasoned, available and around for a long time. And typically the commingled fund is a really good access point. It also provides flexibility for the allocator as well to modulate their allocation sizes in an environment like this. To your point, maybe one wants to have a bit less macro or a bit less CTA. Having that investment in the fund with good liquidity terms provides that optionality.
Yeah, definitely. Yeah, I'm seeing a lot of even mid-size allocators now moving into the SMA space. You have that combination of risk management, transparency, and then you can tune the exposure a little bit more acutely. But it is operationally burdensome, right? You need to have the right team internally that can handle not just risk management on a portfolio level, but be able to look at risk across portfolios. Right. There's a cash management aspect to that as well.
Yeah, I know those are some really good points. I think 2 points on that. One is that as an allocator, even in the funds, I think it's very important to get a high degree of transparency. We've been very fortunate to get that with the bulk of our relationships. So we really have a good sense of what is in the portfolio and what is being invested in. Certainly there are a lot of positives for the SMA. We used to do a fair amount in my prior organization, which include the transparency, which include the potential for higher degrees of risk management. So then the question is, Are they able to utilize that and exercise it? For example, we were talking with one organization that we were looking as a seeding opportunity, and they had the managed accounts, but what they realized is that, of course, the underlying managers wouldn't like it if they were constantly making changes, applying new guidelines and rules, perhaps stopping them out at various times. They have to be careful as well because they're managing a relationship with the underlying manager. So even though one has those, it doesn't necessarily mean that the allocator could or should exercise those capabilities on a frequent basis, et cetera. So there's pros and cons for both.
Right. Yeah, so I'm kind of switching gears a little bit here, but on the seeding side, if a manager were to approach you now, like what does that vetting process and what do you look for in managers before? Because seeding is still a very, very tough part of the ecosystem, both for the allocator and the manager. It's easier now to find talent in a way, but it's much more expensive for them to start companies, I would say.
Yeah.
So from your perspective, like, what do you look for in managers when you're seeding?
Yeah. Well, we've been fortunate. 4 years ago, we seeded ActusRayPartners. It's an equity market neutral fund, and that's turned out to be quite a success. It was seeded with a medium-sized ticket, and today they're over 1.4 billion in size and grown under a short period of time. So that's a really good example of a type of seed that we would like to find. Excellent performance, an excellent communicator in terms of articulating the story, highly transparent in terms of giving information to ourselves and other investors as well. And all of that comes together to build this business, to perform and to build. And it's not easy, as you know.
What's that number for it? Yeah, absolutely. It's super competitive.
It's super competitive,
I mean, I must talk to 300 managers a year.
Yeah.
And, really only a handful of them might have, number one, the performance to show that's provable, that's transparent enough. But more importantly, even less than that, have the business acumen to run a fund, because running a fund is not like running a prop shop, right?
Absolutely.
Yeah.
Yeah, it's certainly very challenging. So, we have a lot of admiration for those who can do it, particularly through the environment we've just been through, COVID, 2022, et cetera, the environment we're going through currently, et cetera. These are some of the biggest tests for hedge funds. I do a chart of, for the amount of time we've been working, we look at the difficult period from 2000 to 2008. And that was a period of a high concentration of difficult periods. And then it was relatively benign from 2009 until 2020. There was a few blips in the middle, but nothing to the scale of that first 8 years. And here, there's a tremendous concentration in a short period of time again.
I totally agree. I think it's really tough to pick managers now because, you're right, the stress test period is GFC period, right? And a lot of the managers who launched maybe 2010, they actually have great track records. And so, for better or for worse, it's been much easier for them to raise capital because they don't have that scar in their book. Managers who have multi-decade or more than 15 years a track record, they have the benefit of being around town, being around the block. And so you can take those blips in their performance and be like, okay, it's understandable. They can explain it so long as they've been able to recover it. You can paint the picture and see the whole story of success and maturation.
Absolutely.
Right? But seeding a manager today, not only, very few of them have gone through hard cycles, but also, even if they did have a track record, because of the regime changes in the last 5 years alone, it's really hard to assess whether they're well equipped for the path moving forward.
Yeah. Well, there's many aspects in terms of what makes a good seed, and there's many different aspects. One is obviously performance. One has to perform very well. One has to be able to control risk in a reasonable way. And then one has to be able to build a business. One has to be able to articulate, market, and promote the business, et cetera. And it's not easy to find that all in one. But if we were to take a few parts, this one aspect of having been through a difficult period, and I mentioned ActusRay, I spent so much time to talk about all the difficult periods. I remember August 2007, that was the quant market neutral blow up. Still remember it very clearly. I went through all of those challenges that managers at that time faced, and he had also been through that period. And that helps a lot, to have been through that difficult period and have that inform how you build a business. And to your point, for a long period of time, maybe managers didn't have that experience, but perhaps to their benefit, the past few years, there's now plenty of data points to feed that into that and inform their build out of that. Because if a manager can talk with experience in a very insightful manner how to deal with problems before they happen, that's, I think, a lot of what allocators, certainly myself, are looking for in a manager. As Sun Tzu said, every battle is won before it's fought.
Yeah.
And all of this planning has to be done well before the difficult periods.
I know a lot of managers would reply and says, well, my best form of risk management is just to pick great stocks and to stay out of risky positions in the first place. Is that sufficient of an answer for you?
There's so much to think about. There's so many things that can go wrong. And if we take that axiom and look at the past 2 months, those managers, if they're long bias, if they happen to be somewhat concentrated, they didn't do much defensive work other than that, they're probably in a difficult situation this year, or certainly through March and the first half of April. So there's a lot to that. It depends what one is looking for, though. If they're okay with a deep research fundamental manager that will take some volatility and bounce through that, et cetera, that may work. But if you're looking for, in this case, thinking about seeds, how they grow through that period, losses and drawdowns always make people uncomfortable.
Yeah. I think some of the managers who come out and maybe previously they were working on the sell side, or maybe they're running prop capital. When they're starting their fund for the first time, they don't realize that having an open-ended fund, meaning that you have monthly subscriptions and redemptions, you have investors who are coming at different points of your investment cycle. And so the day one investor might be enjoying the early returns with you, or maybe understand that you're going through a 3-year period of, let's say it's a medium-term long bias or long only concentrated portfolio. The investor who comes in halfway through that investment period might have a different experience. And if you're not rotating the book enough, or you're not thinking about that new investor, or you have risk management that can accommodate that, then it's not going to be a pleasant experience for them. Right?
Absolutely. I think in the hedge fund world, both the challenge and the opportunity is that there's a monthly report card. Everybody reports pretty much on a monthly basis, and we can see what they have done. The challenge is, to your question, if they are okay with taking more volatility in the hopes they've done good research, et cetera, the challenge is they're going to be compared against dozens, maybe hundreds of other hedge funds. And if those numbers look not good enough, people like myself will say, well, there's a dozen others well-seasoned hedge funds. Why don't I just allocate to these?
I'm thinking like Quant Edge, for example, right? Highly volatile, systematic quant manager. And a lot of managers compare themselves to them as well and says, well, I'm a volatile fund. If you want to invest, this is the type of volatility that you should accept. And if you're okay investing into someone like Quant Edge, you should be able to invest into us, right?
Well, that's a really good example, because I think what Quant Edge did, which is to their credit, is I believe they have a 3-year lockup for their investors. And if the hedge fund is able to lock up your investors for 3 years and ride through that, that's very good. But a lot of emerging hedge funds may not have that ability to make that ask.
Would you be able to seed a manager with a 3-year lockup, with knowing that in mind today?
Well, that's different, because that's not just their seed capital. Quant Edge has a 3-year lockup, I think, for all of their investors, and that protects people, because there's a natural instinct when things are going in a very difficult way to perhaps to risk manage, to take that down, et cetera. So I think that is a benefit to them. But the other side, the positive to that, in terms of making it a more egalitarian world, is that report card can work in their favor as well. And I think that's probably one of the biggest changes from perhaps 20 years ago. 20 years ago, background, pedigree, all of these things were very important and helpful, and it is today. But I think after the launch, after the start, and after months and months of track records, other hedge funds that may not have that background, but they're proving themselves through their performance, et cetera, they can grow, surpass, and really build their business. So I think that is both the challenge and the opportunity set for emerging managers.
I totally agree. I think like the Quant Edge example it has a long track record now. And it's a chicken and egg situation, right? How do you get to that point? For emerging managers who come with a little bit of pedigree, it's still very tough
Yeah.
to raise capital into a 3-year lockup fund.
Yes.
Right? If you were to give advice to a new manager today who is setting up, what would you tell him? I mean, what's the hardest part now? In fact, before I get to that question, we were on a panel last year.
Yeah, that was a very good panel.
Thank you. And one of the topics was, what are the worst mistakes a manager could make? And we're talking about horror stories about, what don't we like to hear?
Yes.
Maybe you can share with a few examples there.
Yeah, that's a good question. We talked to many hedge funds. We talked to emerging managers, startup hedge funds. I would say the most important thing for managers is to really be honest, to really be direct in everything, and to have really thought through their presentation and what it is they're doing. And what I mean by that is, if they're coming across a seasoned allocator, we're going to go through a lot of questions that unpack and try to figure out exactly what is going on. And we know there's no such thing as a perfect hedge fund. So it's really better just to present all of the information. For example, simulated track records.
Right.
Is that really helpful, or is it not helpful? Because I've probably seen well over 100 simulated track records, and they all look amazing. To me, a simulated track record is like a student writing their own report card.
Yeah.
Surprise, surprise, straight A's in every single class.
Yeah.
So presenting the facts, talking about the challenges, talking more about the difficulties, I think that, at least for our perspective, is helpful, because we know everyone is going to face these challenges, and trying to understand what is their psychology in dealing with that, rather than so-called just focusing on putting your best foot forward and presenting all of the positives in a rose-colored way.
Yeah, I think what bothers me, or flags that I have, are situations where the manager will, when I ask them about risk management, specifically around stress test periods, they'll say, oh, this is a Sigma 4 event.
Yes.
If that happens, then it's a problem all managers will have.
Yes.
I don't really like that response, not because it's not true,
Yes.
but because how he thought it through. It's almost like he or she submitted to the, not necessarily an eventuality, but that if there was a Black Swan event like that, or a Sigma 3-4 event, then it would be problematic for everyone. Therefore, we should judge them in the same beta analysis.
Yeah, I
but
agree.
That's not why I'm putting money in you. It's not so that you can be beta. Number two is, I'd like to hear how you think about that environment. Not just how you mitigate, but how you might recover from it.
Yeah.
What policies that you have on managing around that volatility. And it doesn't have to be a straight stop loss. It could be a matter of just managing exposure in a trailed fashion.
Yeah.
And then, do you have a cool-off period? Why would you have a cool-off period? And this would differ whether you're a short-term or a longer-term investor. And so I think that over-reliance on the book building and not enough on thinking through thoughtfully on the risk management kind of bothers me.
Absolutely. What else are you looking for? What are some of the salient features you come across when you see a promising emerging manager?
Yeah, so I think your point about honesty is really key. There's a self-awareness that I'm looking for in managers. Self-awareness, not just in being able to articulate the strategy itself, but when we say, what is your edge? Embedded in that question is a comparative analysis against the market, but also your peers. So it's very reassuring to me when a manager has a very comfortable grasp of where his portfolio or his strategy sits amongst peers. And it means that they've taken the time to measure themselves to a higher metric, because ultimately that's how I, as an allocator, our allocator friends, look at them. I don't look at you just based on your edge against beta or edge against the markets. I'm looking at you against your comps. So it's surprising how few managers have that self-reflection.
Yeah.
Right. Secondly is also business acumen. Right. In business acumen, articulation of your business is one part, but actually you may not have the experience of running a shop, but if you've thought through and you're willing to take up the challenge and break down how you're going to take up that challenge, I think is important to me. I see a lot of managers who come from sell side or even from mega manager sales, and they're like, I just want to focus on the book. And then I don't want to think about anything else.
Yeah.
I think that's really dangerous because if you don't think about everything else, or if you don't have a team to help you think of everything else, it means that you're not taking the execution risk, the business risk of your fund seriously, whether it be custody, counterparty execution, cash management, etc. And so I find that a little bit disingenuous sometimes.
Yeah, I agree with that. What would you say if you could identify some of those breakthrough moments? Like managers have done their job, they've started off, they've built their teams, the performance is going okay.
Yeah.
What have you observed that sort of takes them to the next level or helps them break through?
So assuming that the performance is there, which I think is pretty critical, I've seen a lot of situations where the managers perform very well, but they have an over concentration in maybe one or two investors. And that shows me that even though their performance is great, they're not able to grow the business. And a big problem with that could be maybe they were able to articulate their edge, but only to like that one or two investor who get it, right? And they're not able to scale. So for me, that's trying to figure out, is this because it's a capacity constraint strategy and they're in a niche that makes it not marketable? Or is it because they've not been able to take that marketing to the next level, either working with, pushing their cap intro teams harder or themselves getting out and hitting the road? One of the problems with managers in Asia is that most of them really don't like marketing. They don't like to get in front of allocators, and they'll hire someone younger, but who has some experience, but not enough really to speak confidently about the strategy. And I think they leave a lot of money on the table because of that. Because someone like yourself, you're not going to talk to the IR person, right? You want to talk to the portfolio manager directly. And a lot of the PMs have kind of this diva personality where like, if you like it, you like it. You don't. Here's my salesperson. Communicate with them.
Well, that's a good point. I think that's what I've observed as well. Assuming the performance is intact, or strong, I should say, the team is also built out very well, then communication is so important. Communication from ideally the portfolio manager, and it can be through sporadic emails and communications, but a comfort level with sharing on a periodic basis really helps them build out and get that following.
You've obviously learned a lot in the last 26 years, right? If you were to go back in time, and maybe just to wrap this part of the conversation up a bit, if you were to go back in time to yourself 15 years ago, what would you tell Alan then that you know now?
As it relates to doing this business.
The work that you're doing. Yeah.
As it relates to this work. Yeah, that's a great question, because what's interesting about this job is we're always learning. 26 years later, still so much to learn. Even these past few months in terms of this new paradigm that we're talking about today. So there's a constant learning process to build out, to inform us, to hopefully do things better than before. So I think really trying to put into practice all of the lessons we've learned. And I think this is good for everyone that's doing investing, doing allocating, etc. We're all getting new lessons all the time. And how do we put that into our process? How do we make it a regular check system? And I observe this. It's easy in our business to have a few meetings, to be impressed by several managers, to get that comfort level to write tickets perhaps by a few well-endorsed, famous managers, etc. So I think that's one way to do it. And I think certainly what I believe now and what we put into our process is to be thorough, to really do those checks, to double check, trust but verify, as they say, ask for that information, build a trust with managers, which we work really hard to do. And when you earn that trust, they will share a lot more information with you. And when you have that information, treat it with a lot of respect and confidentiality, do the work, and do all of the verifications and double checking, because the devil is truly in the details. And if we do that extra work, then you can save ourselves a lot of heartache and pain. And I think one person said this: investing is like the game of golf. It's more about making less mistakes rather than trying to hit beautiful shots.
Yeah, I couldn't agree more. With that, I think I'll wrap it up. But thanks a lot for coming by, Alan.
Alvin, thanks so much. It's always great talking to you about so many different topics.
Yeah. All right. We'll catch you on the next one.
Thank you.